You made $10,000, not from a raise, not from a second job, from investing money that grew while you were asleep. For 1 second, it feels like you won. Then tax season shows up. And depending on one detail you probably never thought about, the IRS can take 15% of that money, or it can take more than double that. Same $10,000. Same investor. A completely different bill, and the part nobody tells you is that the detail deciding which one you get isn't how much you made. It's how long you waited. Here's the split in real dollars. If you held that investment for more than a year before selling, the IRS treats your $10,000 as a long-term capital gain. For most middle-income investors, that's taxed at 15%. That's $1,500 gone. You keep $8,500. But if you sold before hitting that 1-year mark, even by a single day, the IRS calls it a short-term gain. And short-term gains aren't taxed like investment income at all. They're taxed exactly like your paycheck, at your regular income tax rate. For someone in the 22% bracket, that same $10,000 now costs $2,200 in federal tax alone. Almost $700 more for the exact same profit, from the exact same trade. And that's before state taxes even enter the picture. That 1-year line is one of the most expensive calendar dates in personal finance. Most people have never heard of it. The lower long-term rate has existed in some form since the 1920s, and Congress has kept coming back to it for one reason: to reward patience. Lawmakers wanted people to invest in businesses and hold on, not flip stocks like trading cards. So the tax code was built to punish speed and reward waiting. Which sounds simple, except most people don't find out this rule exists until after they've already sold. By then, the reward is gone, and the bill is already written. Here's what almost nobody realizes. Your $10,000 gain doesn't get taxed in a vacuum. It gets stacked on top of everything else you already earned that year. Picture your income like water filling a glass. Your salary fills it partway. Then your investment gain gets poured in right on top. If your salary alone already pushes you past a certain point, your capital gain doesn't get the cheap 0% rate that lower earners qualify for. It lands squarely in the 15% zone or worse. And if you're a high earner, there's a second glass filling at the same time. Investment income above $200,000 for a single filer, or $250,000 for a married couple, can trigger an extra 3.8% surtax, the net investment income tax. That's on top of the regular capital gains rate. So the same $10,000 gain can be taxed at 0%, 15%, 20%, or nearly 24%, and the only thing that changed is what else was already in the glass. Meet a version of a very ordinary American investor. Call her Sam. Sam works a normal job, making around $65,000 a year. She's not rich. She's not a day trader. She bought some stock 2 years ago, watched it grow, and finally sold, pocketing a $10,000 profit. Because she held it over a year, Sam qualifies for the 15% long-term rate. Her federal bill, $1,500. Now picture Sam's coworker, Marcus, same salary, same $10,000 gain. But Marcus got nervous during a dip and sold after only 9 months. Marcus's $10,000 doesn't get the investor discount. It gets taxed like overtime pay at his regular rate. His federal bill, roughly $2,200. Same office, same paycheck, same $10,000 win. Marcus just paid $700 more than Sam for waiting 3 months less, and neither of them budgeted for it, because nobody withholds taxes from a stock sale the way an employer withholds from a paycheck. The bill just arrives. Quietly shapes how millions of Americans behave with money. It's part of why financial advisors push buy and hold instead of chasing quick trades. It's why some investors deliberately delay selling a winning stock until they cross that 1-year mark, even if the price is falling in the meantime. It also explains something that confuses a lot of new investors. Two people can have the exact same portfolio, the exact same gains, and walk away with very different amounts of real money, just based on timing and geography. Because state taxes stack on top of everything. Some states, like Texas, Florida, and Washington, don't tax capital gains at all. Others, like California, can add another significant chunk on top of the federal bill. So that $10,000 gain isn't just judged by the ears, it's judged by your zip code too. Here's the part that catches people off guard the most. Most Americans assume taxes on investing only apply when you're already wealthy. But this rule hits everyone the same way: the teacher with a small brokerage account, the nurse who bought a few shares during the pandemic, the guy who sold company stock to help cover a move. None of them are rich by any normal definition. All of them can get hit with a higher short-term rate simply because they didn't know a 1-year clock was running the moment they bought. The tax code isn't just testing how much you make. It's testing whether you know the rules. This isn't a call to never sell, and it isn't investment advice. Markets move, and sometimes selling early is the right call regardless of tax cost. But there are things worth knowing before you're staring at a tax bill you didn't expect. Check the purchase date before you sell, not after. Crossing the 1-year mark, when it makes sense for your situation, can meaningfully change what the years takes. Set money aside when you sell. Nothing gets withheld automatically, so the cash you see hit your account isn't fully yours yet. And remember that losses count too. If an investment lost money, selling it can offset gains elsewhere and lower what you owe, a strategy often called tax loss harvesting. None of this requires being a Wall Street expert. It just requires knowing the clock is running. So maybe the real question was never how much you made. You made $10,000. That part was the easy win. The real question is whether you knew the rules well enough to keep most of it, or whether the calendar quietly decided that for you. Because in investing, the ears doesn't just tax your money. It taxes your timing. If you want more documentaries that explain what's really happening to your money, subscribe to Capital Invests.